Something measurable is changing inside Iraq's monetary framework, and it is not happening through dramatic announcements or overnight exchange rate moves. Instead, it is unfolding through policy sequencing, reserve positioning, and tightening control mechanisms that signal a shift in currency strategy rather than a sudden shock. Iraq continues to operate within an exchange rate environment commonly referenced near 1,300 Iraqi dinars per US dollar. But beneath that stability, structural adjustments are becoming more visible. The Central Bank of Iraq is working within a reserve position reported at over $100 billion, a level that provides operational flexibility unmatched by many emerging economies. Reserves at that scale do not exist merely as financial decoration. They represent import coverage, liquidity insurance, and defensive capability. Oil revenues continue to account for approximately 85 to 90% of Iraq's government income, reinforcing the inflow of US dollars into the financial system and replenishing reserve buffers. This steady inflow strengthens Iraq's ability to manage currency demand without resorting to abrupt devaluation or excessive monetary tightening. In global markets, currency strategy shifts often begin not with exchange rate changes, but with internal restructuring, tightening compliance systems, refining liquidity distribution channels, and reducing reliance on informal market mechanisms. Iraq's monetary authorities appear to be signaling a transition towards stricter discipline and enhanced transparency rather than currency volatility. Stability at 1,300 IQD per dollar has required consistent liquidity management, particularly in an import-dependent economy where external pricing pressures can quickly spill into domestic inflation. Maintaining that stability during periods when global inflation exceeded 6% to 8% in many advanced economies demonstrates reserve-backed capacity rather than vulnerability. Investors watching from the United States, Europe, and Asia should note that strategic currency shifts often prioritize strengthening the foundation before altering visible outcomes. Iraq's current positioning suggests a move toward reinforced stability mechanisms rather than speculative rate changes. The signal is not explosive, it is structural, and structural adjustments often carry more long-term significance than headline-driven volatility. The emerging shift in Iraq's currency strategy can also be observed through increased regulatory oversight and efforts to refine dollar distribution channels within the banking system. In recent periods, the Central Bank of Iraq has emphasized compliance alignment, transaction transparency, and closer monitoring of cross-border transfers. These actions are not cosmetic. They are structural safeguards designed to narrow gaps between official and parallel market dynamics. When a central bank tightens regulatory standards, it reduces distortions that often arise from informal currency trading or speculative accumulation. Exchange rate stability near 1,300 IQD per USD depends heavily on disciplined liquidity control. Even small inefficiencies in dollar allocation can widen spreads in informal markets, leading to temporary volatility. By reinforcing oversight mechanisms, the central bank reduces arbitrage opportunities and enhances exchange rate coherence. In many emerging economies, currency instability begins with a loss of confidence in institutional controls rather than a shortage of reserves. Iraq's reserve buffer of more than $100 billion provides the foundation, but compliance enforcement provides operational credibility. Together, these two pillars, liquidity strength and regulatory tightening, form the basis of strategic adjustment. Investors should also consider inflationary dynamics. Imported goods constitute a large share of Iraq's consumption basket. A sudden depreciation would quickly raise domestic prices, placing pressure on households and government expenditure. By maintaining exchange rate discipline and improving regulatory controls, policymakers aim to stabilize expectations and prevent inflation acceleration. In countries where inflation spirals into double digits, currency weakness often precedes price shocks of 10% to 20% or more annually. Iraq's approach appears calibrated to avoid such scenarios. The strategy shift, therefore, is not toward volatility, but toward tighter control and stronger institutional enforcement. For global dinar investors, this suggests a controlled progression where stability is defended not only by reserves, but by structural improvements in oversight. Strategic discipline often precedes modernization, and modernization rarely occurs in environments of instability. Another component of this evolving strategy lies in reserve management and oil revenue buffering. Oil exports remain Iraq's primary source of foreign currency, and production levels continue to generate substantial dollar inflows. When oil prices fluctuate, reserve management becomes critical in smoothing fiscal cycles. A reserve position exceeding $100 billion provides coverage for multiple months of imports and reduces exposure to short-term commodity volatility. Countries lacking such buffers frequently experience forced adjustments when oil revenues decline, sometimes leading to devaluations of 10 to 30% within short periods. Iraq's reserve cushion significantly lowers the probability of reactive devaluation. Instead, it enables policymakers to absorb temporary revenue dips while maintaining exchange rate consistency. This is a crucial distinction in understanding strategic shift. Rather than pursuing aggressive appreciation or dramatic rate resets, the central bank appears focused on reinforcing resilience. Resilience in currency management often means prioritizing predictability over spectacle. Investors sometimes equate change with rapid movement, but institutional shifts are more often visible in balance sheet strength and risk reduction. By sustaining high reserve levels and refining liquidity allocation, Iraq strengthens its monetary insulation against global tightening cycles and regional uncertainty. Additionally, fiscal planning benefits from exchange rate stability. Government budgets calculated near 1,300 IQD per dollar maintain consistency in salary payments and subsidy management. Abrupt currency shifts could disrupt fiscal projections and create domestic volatility. Strategic currency adjustment, therefore, involves protecting macroeconomic continuity while improving underlying systems. For international observers, the key metric remains reserve sustainability relative to trade flows. As long as oil exports continue replenishing foreign currency holdings, the foundation for controlled currency management remains intact. The visible exchange rate may appear static, but the underlying architecture is being reinforced. Strategic strengthening often appears subtle until it becomes structurally embedded. For Iraqi dinar investors worldwide, the clearest interpretation of these developments is that Iraq's currency strategy is evolving toward consolidation and long-term resilience rather than immediate transformation. Exchange rate anchoring near 1,300 IQD per USD, supported by reserves above $100 billion, indicates a preference for controlled progression. Monetary authorities appear focused on reducing systemic vulnerabilities, improving regulatory alignment, and reinforcing institutional credibility. These adjustments may not generate dramatic headlines, but they enhance policy effectiveness. Countries with weak reserve buffers and inconsistent oversight often face abrupt currency shocks that can erase confidence rapidly. Iraq's measured approach suggests a conscious effort to avoid such outcomes. Strategic currency shifts in reserve-backed economies typically unfold gradually, first through compliance tightening, then through liquidity normalization, and eventually through structural modernization if conditions permit. Investors should pay attention to reserve trends, oil revenue performance, and inflation containment metrics. If reserves remain strong and inflation pressures remain moderated, the environment supports continued stability. Stability itself is not stagnation, it is preparation. When policymakers operate from a position of liquidity strength and institutional control, they retain flexibility. Flexibility is a powerful currency management asset. In global financial markets, resilience often attracts more credibility than volatility. Iraq's current posture signals capacity rather than urgency. For serious dinar investors, the message is clear. Watch the fundamentals, monitor reserve sustainability, observe regulatory reinforcement, and interpret stability as strategic consolidation rather than inactivity. Currency evolution, when it occurs in reserve-backed systems, is usually deliberate and sequenced. Iraq's present trajectory suggests reinforcement before transformation. That shift, subtle but measurable, may define the next phase of its monetary direction.